All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world, and happy Wednesday, everybody. Is it Wednesday? Yeah, it's Wednesday. Today is the 21st of May, 2025. And our top story this morning is consumer stress is showing up in the retailers' earnings reports. We got earnings reports from a couple of big retailers this morning. The biggest one, Target. We also got Lowe's and TJ Maxx. And if you look at what those earnings reports are showing us, you can see signs of a consumer who has just had enough showing in every single one of them. First off, you got Target. Big decline in their comps, their comparable store sales, 3.8% down versus last year. Keep in mind, guys, comparable sales are not adjusted for inflation. So people are spending roughly 4% less money at Target than they did a year ago, even though the price of everything at Target is more expensive than it was a year ago. So what's going on? Consumers just don't have the extra money. Declining consumer confidence they're citing, weak discretionary spending, tariff uncertainty. Of course, anytime you have Target, you always have shopper backlash over something going on because Target steps on landmines that they should have easily avoided time and time again. So that's also adding to Target's problems this morning. But the company also cut their outlook to low single-digit declines for the full fiscal year. That's versus prior guidance of a 1% gain. So, Target's showing things not going so well over at Target this morning. We also got Lowe's reported their earnings this morning. Now, this looked a lot like the Home Depot earnings that we got the other day. Comps were down 1.7%. Again, you're seeing those same-store sales declines. You're seeing a slight miss on earnings. Sales was a slight miss. Earnings was a slight beat. We don't really worry too much about the expectations. But like Home Depot, they maintain their guidance. No mention of tariffs in this article about their earnings report this morning. So like Home Depot, Lowe's is saying tariffs aren't really going to affect us that much. The market is liking that news. But again, that 1.7% decline in same-store sales, you can see home improvement demand it's frozen. There just isn't any demand, right along with the housing market. We're not seeing very many housing transactions. We had mortgage applications were down again this morning. That data came out. The housing market is frozen in place. Prices are moving lower. There's slow turnover in housing. That means the DIYers are doing fewer projects at home, and that is showing up at Lowe's. Again, because stuff just got too darn expensive. People can't afford to do home improvement projects. Now, TJ Maxx is an interesting one. TJ Maxx actually showed us some pretty good earnings. Sales were up 5%. Comparable sales, their same-store sales, up 3%. Oh, wait a minute. TJ Maxx is doing really well. But wait, we got to think about that because TJ Maxx, that is one of your low-end retailers, right? That's apparel. And, what's for sale today at TJ Maxx is what was for sale a year ago at Gap or a year ago at some other high-end clothing retailer. I wouldn't even know which one to name because I don't blow my money on that stuff. But to be honest with you guys, TJ Maxx doing well, not really a sign of a healthy consumer. That's a sign of consumers trading down. TJ Maxx is gaining market share because their consumers can't afford to shop at the higher-end retailers. Once again, even though you got some good news there, if you step back and you think about what is your gauge actually telling you, that's showing more signs of consumer stress there as well. So all three of those stories, not good indicators for the health of the U.S. consumer. We've seen consumer confidence falling like a stone over these last couple of months, finally starting to show up in those earnings. Now, another interesting story that was going around yesterday, FICO or Fair Isaacs Corporation, the credit reporting bureau, they were down big. At one point yesterday, they were down 11%. They ended up closing the day down about 8%. Nobody knew what the heck was going on. And a lot of people were wondering, is this some kind of consumer credit crisis in the making? It looks like there were some comments made by Bill Pulte, who's the director of the Federal Housing Finance Administration, possibly going after the charges that the credit agencies are charging people to have their credit check run. So that caused a big decline in FICO yesterday. We've also got some interesting things happening in Congress that gaggle of elitists that we all just love to hate, regardless of political affiliation. We've got some movement this morning in the House. First of all, they have reached a deal on the SALT cap agreement. You guys may remember from the Trump tax cuts in the first term, one of the ways they paid for the Trump tax cuts was by limiting the state and local tax deduction on your federal returns. And that's how they paid for the tax cuts. Well, that really punished people in high tax states, particularly blue states, New York, New Jersey, California, Illinois. They limited that SALT cap deduction to $10,000. Well, Republicans from those blue states were holding out, demanding that we raise that cap. And it looks like at the last minute they made a deal here. They're going to raise that cap to $40,000 this morning. That appears to be enough to get all of the Republican votes that they need to get this bill through the House without any Democrat support. Now, meanwhile, in the other chamber over in the Senate, there was something very interesting happened yesterday. There was actually a unanimous vote, 100-0. They voted in the Senate to eliminate the tax on tips. The Senate typically can't agree on what time it is, but 100-0. It actually wasn't a yay or nay vote. They basically passed it unanimously. They said, hey, we're going to do this thing. If anybody objects, speak up now. And nobody spoke up. So that's kind of like a unanimous vote, although not technically. They didn't call everybody's name and say yay or nay. But still, it kind of makes you wonder how much of this stuff that we all just think like, come on, guys, this is a no-brainer, get it done. And it's always been stalled in Congress or the Senate because they always attach it to these big bills and everybody pigs out and slaps their pork in it. And the next thing you know, they're voting it down. What if we just voted on these things piecemeal, one at a time, like we just did with the tax on tips? I wonder how much more they might actually get done in Congress. So I just throw it out there. You guys do what you want with it. Also going on this morning, the manager of the Sovereign Wealth Fund of Kuwait is out with a warning about private equity. He's saying all these games you're playing, these continuation vehicles, all these cockamamie ways you're avoiding price discovery in the private equity investment space, that their time is almost up, that there is a reckoning coming for those PE fund managers, those general partners. And coincidentally, on the same day, we got an article in the Financial Times that says President Trump is considering an executive order that will allow 401ks to invest in private equity. Shaking my head. Guys, I'm telling you, know what is in your retirement plan. Everybody's got their guy that manages their stuff, and oh, I like him, and he takes me out to dinner once a year, and he seems so nice. Our kids play Little League together. I get all that. Open the damn prospectus and read what your money is in. Make sure you know what they're putting you into, guys. And if you don't know what it says in the prospectus, don't be afraid of sounding dumb by asking what this means, all right? There's a difference between knowledge and stupidity. A lot of people think not knowing something makes them stupid, and that is not true. Guys, I'm telling you, they are going to be putting our retirements into this stuff, your pensions, your IRAs, and your 401ks. They're using it as a parking lot for all of the toxic sludge in Wall Street, and it looks like President Trump is trying to clear the way for them to do it with private equity here. Know what is in your plan, guys. Good God. And last but not least, we've got worries this morning. The oil markets were a little bit higher last night. There are worries that Israel might be set to attack Iran's nuclear facilities. I'm not quite so excited about this story. I suspect this is possibly a negotiating tactic, something that's being used to try to strong-arm the Iranians into some kind of negotiation with the U.S. And look, even if this does happen, even if you do end up with another missile exchange between the two countries, the oil market is oversupplied, and it's going to continue to be oversupplied thanks to the Saudis and everything that's going on at OPEC+. So I really don't think we're going to see substantially higher oil prices here, not unless the Iranians outright block the Strait of Hormuz, and right now that is just not on the table. So why don't we shrink my big melon of a head and let's see what's going on in the markets this morning, shall we? Hey, don't forget that like button for the YouTube algorithm and that subscribe button, because we do this every morning. So come on back and have your coffee with the melon heads. Right now, the S&P 500 is 42 points to the downside, 0.7% lower here this morning. And the Dow is also lower, almost over 0.9%, about 400 points. There's the 4-0 handle. 400 points in the red this morning in the Dow. We've got United Health is falling again this morning. We'll show you that one in a little bit. The NASDAQ, meanwhile, is down by about 0.75%, 157 points in the red this morning. So stocks are red across the board. We've got the U.S. dollar is back below 100 here this morning, 99.61, off by 41 basis points So WTF is going on with the dollar? Well, let's see if the bond market tells us anything. We've got yields a little bit higher this morning. Not a lot. Nope, that's not what's triggering the dollar. The 30-year Treasury, 5.021. That's higher by about 5.5 points. The 10-year is at 4.540. That's higher by about 6 points. The 2-year, meanwhile, is at 4.002, higher by 3 points and change. And the 1 month is unchanged at 4.292. A big one that we were watching yesterday, those Japanese super long bonds. Let's see what's going on with them. They are higher again this morning, albeit only a small amount. They're higher by 5 basis points, 3.625% for the Japanese 40-year JGB. So still that problem is getting worse over in Japan. We're still seeing those interest rates rise. We were as high this morning as 3.681. So still got those moving higher. Let's see check in with the Bank of Japan. What's going on over there? BOJ hearings underscore divergent opinions on bond tapering pace. The Bank of Japan is pretty much telling the market, is saying, hey, we're thinking we might lower rates. We're thinking we might raise rates. We want to taper our bond purchasing. What do you guys think? And the market is saying, I don't know. What do you want? It kind of depends on, well, what's your positioning at your institution? The Bank of Japan heard mixed views from market participants over the 2 days on how quickly it should taper its bond buying, input that will help guide its quantitative tightening plans as signs of strain build in the bond market. A wide range of opinions had been expected from participants, including mega banks, regional lenders, securities firms, and life insurers ahead of the hearings. Those with larger government debt holdings, such as local banks and lifers, were seen as likely to favor a slower pace of reductions to ensure a smooth transition, with recent jumps in yields illustrating that pulling back of central bank buying isn't without risk. But the divisions extended to the country's biggest banks, with some lenders pushing for an acceleration of reductions, while others advocated for a slower BOJ retreat from the bond market due to concerns about supply and demand imbalance in the super long segment of the market. According to participants at 2 days of hearings, which ended on Wednesday, the country's biggest lenders posted record profits for the year ended March, due in part to wider lending margins resulting from higher rates. So look, the big banks like the higher rates because they get to issue loans at higher interest rates. They make more on their interest. But the big banks in particular, they like higher rates because if small banks fail because of losses on their bonds, the big banks get to gobble them up at a discount and big banks get bigger. See also JP Morgan. So there's a lot of talk in Japan right now. And one other thing I wanted to look in on before we move on from here is the USD JPY chart. Okay, this is possibly contributing to that decline in the dollar this morning. We're seeing the yen strengthen once again here, 143.74 yen to the dollar. That's down about 0.75. Again, this chart moving lower is showing a strengthening yen versus the dollar. And the yen has been slowly strengthening for a week straight now here. Not quite back to those crisis levels that we saw in the beginning, middle of April, but we're getting there, aren't we? So keep an eye on that yen chart. Let's look over at the commodities board. We've got gold back above $3,300 here. Spot gold is at $33.05. That's higher by about $15 or 0.46% higher off the highs of the morning, but back above that 3,300 threshold. Spot silver, meanwhile, is up by about a dime or 0.3% higher at $33.17. I like the shiny. Copper, meanwhile, is up about 0.75%. Platinum is up about 1.5%. Palladium is up about 0.2%. And there's that move in oil that we talked about, higher by about 1.25%, $62.78 for WTI crude oil. Let's just talk about that one real quick, shall we, while we're on the subject. Oil climbs on report that Israel is preparing to strike Iran. Again, this is just rumors here. Nothing is confirmed. Nobody's responding to requests for comment. Oil rallied following a CNN report that new U.S. intelligence suggests Israel is preparing for a potential strike on Iranian nuclear facilities. Brent crude rose above $66 a barrel. It wasn't clear that Israeli leaders have made a final decision on whether to carry out the strike, CNN said, citing unidentified officials. Oil has been volatile since last week on mixed headlines about the fate of Iran-U.S. nuclear talks, which could pave the way for more barrels to return to a market that's expected to be oversupplied later in the year. An attack by Israel would hinder any progress in those negotiations and add to unrest in the Middle East, which supplies about a third of the world's crude. So that's contributing a little bit to your higher oil prices this morning. Let's check out what's going on in Bitcoin. We are higher than we were yesterday. It's showing as red here, but that's just because Bitcoin trades 24/7 and the candles are somewhat misleading like that. But we're at $106,422 here. That's technically down about $400. Now, this morning we were as high as 108,000. It really looks like Bitcoin has now broken out of that. We'll call it a flag pattern. Well, man, sloppy drawing there, Jack. Oh, what would the penmanship teacher say? Bitcoin has officially broken out of this pattern. We are moving out higher here. Still yet to make a new all-time high. The all-time high was set on January 20th. That was 109,358. So we're still a few grand shy of that, but it looks like we will be challenging those levels in the days ahead. Now, let's talk about this Target report here. Target cuts their outlook on shopper pullback and hit to retailer sales. Consumer is not looking so good here. Target Corp cut its sales forecast following a weaker than expected quarter. The latest sign the big box retailer plans to recapture growth are faltering. The company now expects net sales to decline by a low single digit this year, down from previous guidance for an increase of about 1%. In the quarter ended May 3rd, comparable sales dropped 3.8%, more than analysts had expected on slower shopper traffic. Consumers also spent less per visit. Yuck. They're lowering their guidance. They were forecasting growth in sales. Now they're saying a decline. We got almost a 4% decline in comps. Fewer consumers entering the store. The ones that do enter the store are spending less. There's not a lot to like here. I want to be clear that we're not satisfied with this result, CEO Brian Cornell said during a call with reporters. He added that Target is moving with urgency. Well, we're very thankful for that, Brian. We've got to drive traffic back into our stores and visits to our site, make sure we're building momentum. Cornell attributed the results to weakness in discretionary spending, declining consumer confidence, uncertainty over tariffs, and shopper backlash against the company's decision to halt diversity initiatives. He listed growth in e-commerce as a bright spot. So Target always has some controversy or another going on there. That's also adding to the problems with the consumers. Target stock down 7.5% ahead of the opening bell this morning, trading at $90.60. It has been a rough year for Target, down 37% from where we were a year ago, and the problems just keep adding up. Meanwhile, let's check in with Lowe's. We talked about Home Depot yesterday, and we got some similar results from Lowe's. Lowe's sticks by full-year forecast as sales from home professionals boost their business. Lowe's on Wednesday stood by its full-year forecast as growing sales among home professionals helped offset slower demand from do-it-yourself customers. The home improvement retailer came in just shy of Wall Street expectations for quarterly sales, but beat earnings estimates. Shares of Lowe's rose nearly 3% in pre-market trading. In the company's news release, CEO Marvin Ellison said investments in its stores, technology, and customer service has helped the retailer get through near-term uncertainty and housing market headwinds. Home improvement demand has been slower as high interest rates and slower housing turnover ding U.S. consumers' appetite to spend on pricier projects. Yet with its outlook, Lowe's predicted it will snap out of this sales slump this year. And I just want to add, comparable sales decreased 1.7% year over year. Weather hurt sales demand, but sales on Lowe's website and among home professionals grew, the company said in a press release. So 1.7% decline, a slight miss on sales. Not a great report for Lowe's here, but they are being a little bit rosier in their forecast and no tariff uncertainty here. So the stock is up about 1.1% ahead of the opening bell, $233.80 for shares of Lowe's. Meanwhile, looking over at TJ Maxx, we've got TJX stock dips as same-store sales fall slightly short. Now, this is actually kind of a misleading headline here. Same-store sales actually rose, but they rose less than expected, and so the headline is fall slightly short. Kind of suggests same-store sales were down, but they weren't. Sales rise 5%, and its profit narrowly beats analyst estimates. TJX company stock fell 1.6% in pre-market trading on Wednesday after the retailer's first quarter same-store sales growth of 3% fell slightly short of the FactSet consensus estimate of 3.1. All right, so they're putting a negative spin on this, but same-store sales growth of 3%, contrast that with the negative 1.7 at Lowe's and the negative 3.8 at Target. You can see TJ Maxx is doing a lot better than some of their peers here. First quarter sales rose 5% to $13.1 billion ahead of the analyst projection. The store operator's first quarter profit of $1 billion or 92 cents a share fell slightly from $1.07 billion or 93 cents a share in the year-ago quarter, but beat the analyst estimate of 91. So kind of a mixed bag here for TJ Maxx stock. The important thing is they are gaining market share. You're seeing those same-store sales rise 3% here. It's probably because they are capitalizing on consumers who can no longer afford to shop at some of those higher-end retailers. Now, if we look at TJ Maxx stock here, it's down about 2% pre-market, trading at $132.25. But over the last year to date, this stock is up 11.7% here. So it's had a very good beginning of the year. Over the last 1 year, the stock is up about 38%. This has done really well. And looking out over the last 5 years, it's up 165%. You can see how TJ Maxx has really been reaping the whirlwind here as consumers have been strapped by inflation. They're trading down and they're shopping at places like a Ross, like a TJ Maxx, where the clothes are cheaper. People are making do, and that is very good for a company like this. All right, let's talk about what happened at FICO yesterday. This was a big one, and a lot of people were scratching their heads. FICO sinks after Bill Pulte remarks about buy-merge credit scores. Shares of FICO sunk Tuesday following remarks by Federal Housing Finance Administration Director Bill Pulte at a Mortgage Bankers Association conference. When asked about the agency's push to change from a tri-merge credit score to a bi-merge credit score in the underwriting process, Pulte said, "I think FICO should make sure they're being as economical as possible. We're actively looking at getting it done. I don't like some things I've heard in terms of the cost. I had the title lobby in as well, and I said to them, look, I think you guys have got to be super smart. Americans are upset about what happened over the last 4 years." Shares of FICO closed down 8%. Credit reporting agencies Equifax and TransUnion also closed down lower. All of the shares of these credit agencies were closing lower yesterday. You can see that in shares of Fair Isaac or FICO Corporation. They were down 8.1% yesterday. They're down another 3% and change this morning. Look, the guys in Federal Housing and Finance Administration, they're saying you're charging way too much for these credit reports that people are running when they apply for a mortgage. And it looks like the government is going to be taking some action. They're talking about this bi-merge versus a tri-merge. And I'll be honest with you, I don't really know what bi versus tri-merge means. Obviously, there's one less merge if we go by the prefixes. Beyond that, I couldn't tell you WTF they're talking about. But whatever it is, it looks like it's going to hit FICO in the credit in the wallet here. Big decline in their stock yesterday, continuing here this morning. Meanwhile, Congress says they reached an agreement on a $40,000 SALT cap increase. Let's not spend too much time on this, mostly because I just hate Congress. But this was the big hurdle that was remaining. There was several Republican holdouts. You're talking Republicans from blue states, people who are just barely clinging to their seats in Congress. They wanted this SALT cap to go away. They wanted to raise that ceiling if they couldn't get it to go away outright. That way, those people in those high tax states would be able to deduct their state and local taxes from their federal taxes. The cap was previously $10,000. Now it looks like they've cut a deal and it's going to be $40,000. So it looks like the House will probably be able to get this bill through now. It's never done until it's done. But then once it gets to the House, then begins the whole process in the Senate. Rinse, repeat, another ridiculous exercise. And then whatever bill the Senate passes, they have to go through the reconciliation process, make sure it jives with the House bill. So we're probably not going to get anything done here for quite a while. But one thing that did get done, U.S. Senate passes no tax on tips bill in a unanimous vote. Now, look, this was a unanimous vote. That's kind of cool. I got to ask, does this really matter? I mean, look, this is some tax relief for some low-income households. Great. I get the feeling people who earn most of their income in tips probably don't report all of their income to the IRS anyway. I'm just throwing it out there. They probably don't do that. I don't really care that they do that, to be honest with you. And, you know, my heart weeps for the IRS, let me just tell you. That being said, it's nice to see the Senate getting something done here. Look at this, 100-1. The U.S. Senate passed the No Tax on Tips Act. Freudian slip there. No Tax on Tips Act on Tuesday after the Nevada Senator Jackie Rosen brought the bill up for a unanimous consent request. This bipartisan bill is a good idea. It has support from Democrats and Republicans, so we should pass it. Well, as soon as possible, without any poison pills, said Rosen, a Democrat on the Senate floor. The bill was introduced in the Senate in January of 2025 by Senator Ted Cruz and a bipartisan group of co-sponsors, which included Rosen and the Nevada Senator Catherine Cortez Masto. No objections were made by Rosen's request, resulting in the passage of the bill, which now goes to the House. Again, this wasn't a roll call, yay or nay vote. This was, we're going to do this. Does anybody object? Nobody objected, and so it goes on to the House. It's nice to see them getting something done. It is possible for them to agree on something other than adopting August 11th as National Eat a Watermelon Day, all right? We can actually get something done by the Senate. All right, now here's one to watch out for. Private equity is troubled. $1 trillion Kuwait fund boss warns. And why does this affect you? We'll get to that, trust me, but this definitely does affect you. The head of one of the world's largest sovereign wealth funds said the clock is ticking for private equity and joined the chorus of investors who've grown worried about the industry's valuation practices. The industry has struggled to return money to investors for years, said Sheikh Saud Salem Al Sabah, managing director of the $1 trillion Kuwait Investment Authority. While that's mostly been due to a lack of deals and IPOs, Sheikh Saud said some firms were underwriting deals at valuations that they would struggle to exit. In other words, they are lying about what this stuff is worth. With a persistent valuation gap between buyers and sellers, monetizing assets through sales or IPOs has become difficult for many private equity funds. So-called continuation vehicles enable those firms, which are known as general partners, to keep their best performing assets beyond the usual tenure. Those vehicles allow buyout funds to generate returns at a time when most investors or limited partners are clamoring for cash back, a trend that's made it hard for the sector to raise fresh funds. Now, guys, there's a lot of things going on here. These so-called continuation vehicles, what they're doing is they're creating new funds and they're putting the assets, the companies that they bought in their old fund, into the new fund. And then the money they raise for the new fund goes to pay back the investors from the old fund. So it looks like the old fund made a profit. And if you're sitting there saying to yourself, well, gosh, Jack, that sounds an awful lot like a Ponzi scheme. Well, congratulations, you've been paying attention. That is exactly what the whole private equity industry is doing. And this guy from Kuwait who manages $1 trillion, he's waving his flag. He's saying BS flag detected here. And this is important, guys. This has been going on for years. I've been raising the flag on this for at least 2 years. First, they started calling them net asset value funds or NAV loans. Then they started, what are they calling them? Continuation vehicles here. They are Ponzi schemes. That's essentially what they are. And the reason why this affects you, as this Kuwaiti guy is warning about this, you've got this in the Financial Times. Donald Trump considers an order to open U.S. retirement plans to private equity. If they can't sell this crap to the IPO market, and if they can't sell this crap to their continuation vehicles, and they can't sell this crap to pension funds, well, you better believe they're going to figure out a way to sell this to your 401k or your IRA. President Trump is clearing the way for this to happen. And again, they won't bail out private equity funds. They won't bail out hedge funds, but they sure as shit will bail out pension funds and 401ks. So first, they need to park all this toxic sludge in your retirement. Then we'll get price discovery. Then you'll lose all your money. And then the government will start talking about bailouts. And you'll be in favor of the bailout because they're not talking about bailing out banks. They're talking about bailing out you. You can see them putting these pieces in place. They've been doing it for years now. And President Trump, at the end of the day, he is one of they as well. No different than the rest of them. Here we go. Big handout to private equity, courtesy of your retirement plan. And let's talk a little bit about United Health here, shall we? How sick is United Health? How a wave of bad news wiped $280 billion off the insurer's stock value. Guys, I want to talk about this one because UNH is down again this morning. Here's this series of events in this article. And this is, it's really striking just how suddenly this happened. Right? We've been talking about the frauds at United Health since last summer when Wall Street Journal ran that article about Medicare Advantage fraud. And then, of course, with everything that happened with the assassination of the CEO that was brought to the forefront. But starting in April, CEO Andrew Whitty delivered first quarter results so alarming that the stock plunged, knocking 22% off the company's share price within hours. 26 days later, on May 13th, the company sent out an early morning statement announcing Whitty had resigned for unspecified personal reasons, and that Stephen Hemsley, the board chairman and previous CEO, would be CEO once more. The stock plunged again. The next day, the Wall Street Journal reported that the Department of Justice is investigating United Health for possible criminal Medicare fraud. The company said it hadn't been notified of any such investigation, but the stock plunged yet again. You can see here in just a series of a couple of days, $280 billion of market cap off of these three successive headlines: the bad earnings, the CEO retiring, and then the criminal probe. It just takes down the biggest contributor to the Dow Jones Industrial Average, knocks $280 billion off of their market cap. And I just couldn't help but crack up at this one. Shout out to my moderator, Mish. HSBC this morning, they cut United Health to reduce from hold and cuts their price target to $270 from $490. Way to get out in front of that one, HSBC, moving at the speed of continental drift. And look, guys, these analysts, that's just, I love this example because all these analysts that always maintain their buy, their hold, right? By the time these analysts get around to accurately handicapping what's going on at these companies, the move has already happened. All right. This company has already dropped by more than like 40% in a couple of months. And now this guy gets around to cutting his price target to United Health from $490. Right now, United Health down another 5% this morning, $305.12 for UNH. Let's just look at a 1 month chart of this one. And let's go out year to date. You can see here's the earnings report, a big decline. Here's the CEO retiring, a big decline. A day later, we get the DOJ probe. It declines again. Now, United Health has bounced for a couple of days here in the red again this morning. I don't think the bleeding is quite over for this company. I think we're going to see a lot of congressional hearings, probably some charges against some people. But for now, this one's pretty beaten down. Probably got a crowded short trade going on here. This is going to be pretty volatile for the next couple of weeks. And last one I want to talk about here, mortgage application volumes in the U.S. shrank by another 5.1% from the previous week, ending May 16th. That's the sharpest drop in 1 month. We've had interest rates moved a little higher. So, of course, applications are down again. Applications to buy a new home, fell by 5%. Applications for a contract to refinance a mortgage, which are typically more sensitive to changes in interest rates, also fell by 5%. So the housing market continues to be frozen in place by higher rates with another 5% decline in mortgage apps. And I just want to say thank you very much to Mr. Austin Feinberg. Thank you, Austin, for supporting the channel. He's saying, please have your next video with Melody and Locks ASAP to cover commercial real estate. Oh, we got some homework here. We've got a piece of legislation, Florida Bill HB 913. I am not familiar with that piece of legislation, Florida HB 913. All right, it's going in the notes here. That now permits HOAs to take on debt without members' consent. Great content. All right, Austin, that's news to me, that bill, but I can tell you without even digging into it why that's going on. That is that Oceanside condo collapse. That's why they're doing this. They're letting HOAs borrow money because what happened is the HOAs, all of a sudden, all these condo buildings, which, by the way, speaking freely, guys, cocaine built the whole freaking city of Miami. I don't know if you guys knew this. In the 1980s, there was this magic white energy powder that was very popular in the United States and Florida by way of Colombia. Miami is pretty much where most of that money came into the United States through. And of course, the best way to launder illicit proceeds is by real estate development. See also Dubai. And so besides the fact that you had cocaine money that was building all of these buildings in Miami, the developers who were building these buildings paid for by cocaine money were also using the product, as were most of the workers who were building the buildings. They cut a lot of corners. There was a lot of, when everyone and their brother gets into building condo buildings, people just make mistakes. And then 20 years later, 40 years later, actually, you end up with a building collapse that kills a bunch of people in the middle of the night. So they went and they started investigating all of these buildings, and they realized, oh my God, half of the city is ready to freaking fall down because we did such an awful job building these things. It's kind of like what's going to happen all over China in 30 years. Now they need to make these major upgrades and repair to these buildings. And you're talking tens of millions of dollars. And so these condo owners are getting bills, to say your typical HOA fee is like $250, $300 a month or whatever, maybe $400 or $500 for the nicer places. All of a sudden, they're getting these special one-time assessments for $150,000 so that they can basically shore up the foundation of the buildings. And of course, these people are like, we're screwed. We can't do this. They can't even sell their way out of it because that liability is now attached to the ownership of the condo. So you're stuck eating this. So one thing they're trying to do is this bill would allow these HOAs to borrow that money and then dilute that cost across future years. Is that a good idea or a bad idea? Honestly, I couldn't tell you. The whole idea without members' consent, that sounds a little shady to me, but it's definitely because of that Oceanside condo that they're doing that. And of course, HOAs, man, they're notorious for those box wine drinking Karens who get a little bit of power. Next thing you know, they're telling everybody what color their curtains have to be. And so if you give them the ability to borrow money without asking for permission first, yikes, the kind of stuff that's going to come out of that. So hopefully they're putting some kind of limitations on that. Oh boy, what's the worst thing that could happen? Thank you, Austin Feinberg. I will look into the specifics of that one. Good tip, sir. And thank you for supporting the channel. Nashville Pasta Man says, AKA Tennessee taxpayers subsidize California state taxes. Oh, are we talking about the salt cap deduction? Yeah, that is one way to look at that. Absolutely. You are, by deducting the higher taxes in the blue states, you are shifting that burden to the taxpayers in the lower tax states. Absolutely. And look, the whole point of the salt cap deduction was to convince the state and local governments to lower their taxes. And, well, they sure as heck didn't do that, did they? Good point, Nashville Pasta Man. And thank you, sir, for supporting the channel. Pigo's Trading Desk says the last strip mine, grandma's pension, sadly. Yeah, absolutely. You can't strip mine the countryside for coal or for cobalt, but you can still strip mine grandma's pension. Absolutely. And don't worry, it's not just the pension. It is the 401ks and the IRAs too. That Trump executive order on private equity investments just freaking stinks, guys. I mean, I'm telling you, make sure you talk to your guys. Make sure you know what is in your retirement portfolio, because Wall Street is sitting on this steaming bag of burning dog poop, and they need to hand it to somebody. And man, your 401k is looking awful appetizing to those PE firms, let me tell you. And it looks like President Trump is clearing the way for him. Thank you, Pigo, for supporting the channel. Also, Wolfspeed. I don't follow Wolfspeed. I did see that move. That's a big trending stock. It was down like 40% this morning. I think, correct me if I'm wrong, but isn't that one of those quantum computing stocks? Look, quantum computing is the next shiny new thing. Just as soon as this AI bubble bursts, you watch every one of these muckety mucks on Twitter and on CNBC. They're going to instantly pivot to quantum computing as the next big thing to round trip revenue and bid up valuations on. So I think that's what's going on with Wolfspeed. I didn't look too closely into that one, but thank you for the tip, Mr. Pigo. Appreciate the support of the channel. Charles G says, I sent you something on Twitter on a nuclear company called TerraPower. That is the company Bill Gates is invested in. They said they broke ground in Wyoming, but maybe have a clear from the NRC. All right, I don't know about the specifics on Wyoming. To my knowledge, this is, if I had to guess, this is probably a national lab that they're breaking ground on, or maybe they're doing early site prep work. I don't quote me on this, but I don't think TerraPower has received design certification from the NRC yet for that reactor, which means they're still not allowed to build and operate one commercially. But they are allowed to break ground. They're allowed to do early site prep work. There's a lot of lesser milestones before that design certification, so there may be some progress being made there. But the only small modular reactor to receive design certification from the NRC was NuScale, and NuScale has canceled their only planned reactor. So I don't think that means new SMR coming through. It doesn't mean any big changes have been made. Look, the fact is the NRC is still made up of, or at least the commissioners on the NRC, half of them are anti-nuclear activists, and they're not going to get out of the way just because a bunch of AI data centers got built. And unfortunately, the NRC, it's a lot like the Federal Reserve. Those guys are appointed by the president, confirmed by the Senate, but they can't be fired. They're an independent regulatory agency. The secretary of blank can't decide, I don't like what you're doing, and replace you. It's a lot harder to get rid of them. So I think we're stuck with those commissioners for the time being, which means don't expect any major breakthroughs in the regulatory environment anytime soon. But Chuck, I will look into that TerraPower story and make sure that that hasn't changed. But thank you again, sir, for the tip. And Austin Feinberg is back again, says, Jack, HOAs in Florida are now essentially taxing entities. Man, I lived under an HOA once in my life. Never again. I could not stand those people. I'm telling you, I once got them to allow me to do something to my house that they didn't want me to do it by threatening to stay. Like, I was like, look, guys, I'm going to sell my house. You either let me do this and I'll sell the house, or don't let me do this and I'll stay. And they voted unanimously to let me leave. So, yeah, me and my libertarian ideology did not get along with the HOA very well at all. Nearly 60% of HOAs currently get insurance because they couldn't meet reserves. Oh, can't get insurance because they can't meet reserves. Well, that's another thing, these HOAs, because the buildings are collapsing and because they've done these structural reports, which they're now required to do, the report comes back and the building is a wreck. The insurance company is saying, fix it or we're out. And of course, they have to fix it. Well, that means they got to bill the owners for those repairs. And the owners are like, I don't have $100,000 for this. And so, yeah, it's a mess. That Oceanside condo collapse made a real mess in Florida. You can add that to all of the worries in the housing market in Florida. If you're worried about a bubble, look, you got aging demographics, boomers moving down there. Florida is always ground zero for housing bubbles. You could add places like Vegas and places like Phoenix, Arizona on top of that. But Florida's got a reckoning coming in that multifamily real estate for sure. And condos and HOAs are front and center for that one. Thanks again, Austin, for the information and the support of the channel. Flip Antley. What's going on, Flippantly? I shall flippantly read Flip Antley's message. He says a pair of formerly $200 million downtown Denver buildings sold for $3.2 million last month. Wow. So it looked like $196.8 million seems to have gone up in smoke there. This can't be right. The guy from Starwood told me the bottom was in 2 years ago. How's that happening? Wow. 200 million down to 3.2 million. Yikes. Very hushed about former owners' losses. I wonder what bank is taking that hit. I really doubt the former owner is going to take the loss. I am sure, as a matter of fact, that it is the bank that lent to the former owner that is going to take that loss. Wow. We're going to add that right next to Florida HB 913 that we got from Mr. Austin. We are going to add that to Flippantly's 2 Denver buildings. Wow. 200 million to 3.2 million. Yikes. I knew commercial real estate was bad, but holy crap, guys. That's like that's almost exactly a 98.5% decline, isn't it? Or something like that. Jeez. Commercial real estate, that's another one of those, the floor is price discovery stories, like we don't tell people what it's actually worth, not until we've parked all that debt in somebody's pension fund. Then we say, oh, who could have seen this coming? Well, we better bail out the pensions. I mean, you don't want to throw grandma off the cliff, do you? That's what they're going to do, guys. I'm telling you, the political pieces are already being put in place for that. Thank you, Flip, for the tips, or good information in the comments today, guys. And John, thank you, John, says junk silver to XYZ dollar to bar ratio and why. Junk silver to XYZ dollar. John, honestly, I'm having a hard time telling what you're asking there. Junk silver to bar ratio. Something to do with premiums there. I honestly, I'm having a hard time figuring out what it is you're asking about there. Do me a favor, John. If you click on the About Me section of my channel, you prove you're not a robot, you can get my email address and send me an email. Elaborate a little bit on what that question is, and I'll take a crack at it. But if I had to guess, talking about junk silver and bars, we're seeing collapsing premiums right now because a lot of retail investors who bought a lot of silver years ago are now being forced to sell, not because they want to, but because they have to. That's causing the premiums to collapse quite rapidly. We're seeing very low premiums on American Silver Eagles, American Gold Eagles. And I'm sure because those premiums are collapsing, you're probably seeing, you're seeing the price on that junk silver is a lot closer to some of the more expensive stuff than you might be used to seeing. I think that's why, even though prices are rising right now, you do have a lot of forced selling in that physical market, which means those gold dealers are not doing well. And I would reference that interview I did last week, or was it 2 weeks ago, with Bob Coleman? It was last week with Bob Coleman from Idaho Armored Vaults. We talked about that in great detail. Thanks again, John. Feel free to email me more information about that question, and hopefully I can give you a more detailed answer than that. And thank you, everybody, for having your coffee with the Melonheads this morning. I appreciate all the generosity in the super chats, as well as you, my magnanimous Melonheads on Patreon and YouTube. Thank you guys so much for all the support of the channel. I got links down below to all that good stuff, should you feel so inclined. Don't forget that like button and that subscribe button on the way out for the algorithm. Hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream big.